Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this week's edition of Through the Noise. Russia and Ukraine are dominating the news headlines and market movements this week. It's at times like these that it's useful for investors to, rather than getting consumed by the minute-to-minute news flow, try to step back and figure out the constraints faced by those involved and what this means for their actions and overall outlook. This is what we do in our weekly market view publication this week, which is titled What to Make of the Ukraine Crisis. To take us through our perspectives of the evolving situation, I'm really pleased to have Daniel Lam, who runs our equity strategy team based in Hong Kong, with me today. Apart from the Ukraine situation, we'll also discuss its implications on oil and energy stocks, Europe and China earnings, as well as whether the yen is a safe haven. So, Daniel, let's start with Russia and Ukraine. So most of the commentary is obviously focused on will they or won't they in terms of whether Russia will invade Ukraine. This is obviously important for investors, but maybe you can explain why Ukraine is potentially important.
Well, the most important point is that whether Russia may be cutting off the natural gas supplies to Europe, which would add significant issues on the humanitarian side. And given that we are in the depths of cold or depths of winter in Europe, this is, potentially an issue where there are major implications. And of course, that would feed through to natural gas prices and also ultimately into oil prices.
Okay, so the way I like to think about geopolitical decisions is the constraints facing different policymakers, as I think this can be very instructive when it comes to trying to predict what they'll do in different scenarios. So from where I'm sitting, it sounds like Europe has a pretty weak bargaining position given its reliance on Russian natural gas. What do you think this means for the likelihood of Russia and Ukraine situation being something we're still worrying about in 3 months' time, say?
Well, actually, it is more two-way. It's not just Europe, but Russia's also got its own concerns because basically, if this is a long drawn-out process, and if there is any, hits to the supply of natural gas and oil, this would hit the Russian economy really badly because they're still depending a lot on their revenue from these two supplies. Europe, of course, we want to avoid this because it's going to damage the economy even further. And of course, Russia, they don't want to give Europe an incentive to plan for any energy security without Russian gas supplies. So it's really two-way. So we don't see a long drawn-out process to this, but in the short term, there is likely to be volatility ahead still. And it does not rule out the possibility of Russia going into Ukraine in some shape or form. But it does mean that NATO is likely to be reluctant to get fully involved militarily.
Okay, so let's move on to financial markets. What does this mean for investors?
We think that basically this is a short-term, phenomena. We want to look through the noise. We want to look at the growth picture and the inflation picture. We think that is still the key factors, more longer-term factors that is driving the markets. So growth, basically, if you look at this week's figure, we see stronger than expected U.S. retail sales data, but inflation is also remaining very high. So this is putting the pressure on the Fed to react strongly to this. But if you look at other indicators, the yield curve is flattening. There's a decline in long-term inflation expectations, and China's producer price data is also looking weaker. So this is suggesting that explains why this week's release of the minutes from the Fed meeting is a little bit more balanced than what people thought it would be. But we think that right now there is a current weakness in the cycle, but we see that as a mid-cycle pullback rather than the end of the cycle. So we think that investors should still be using this as a window of opportunity to gradually add risk to their positions in both bonds and equities.
Okay. Then let's move back to oil. Maybe obviously higher oil and gas prices have been a boon for the energy sector. Energy equities are up 17% year to date, obviously against the trend we're seeing in most other sectors. In your opinion, what's the impact of higher oil prices going to be going forward?
We think that energy sector is likely to be supported in the near term because you see that basically the earnings for the full year 2021 has been very strong. It started from no base, but it's very strong in the energy sector. In 2022, we see that the earnings growth is likely to normalize. But if you look at the price action in the energy stocks, you can see that in terms of from a technical perspective, it is looking very reasonable in terms of return versus risk. So you're seeing that on, I guess, days of pullback, the key level of support were being held with very good buying volume. And on the upside, it's grinding very nicely. Okay, so we think that in the short term, there's still reasonable upside for the sector. Another asset class that you may think about is the emerging market bonds, because one would think that higher oil prices, especially from those oil exporting countries, would help this EM bond index. But if you look at historical analysis since 1994, there's no close relationship between the bond index and the oil prices. So we continue to see the EM bonds as a core holding rather than preferred asset class for now.
Okay, so let's move on to earnings season in Europe and China. Obviously, we've had earnings seasons in the US. That's generally been pretty good. But from a Europe and China perspective, what are you looking for from here?
Okay, so in Europe, about half the companies in Stock 600 have reported their earnings, and they have surprised on the upside mildly. Okay, the sector that is in focus is technology sector, which is delivering the biggest positive earnings surprise. And it is a sector that we are overweight on, and we continue to do so. In China, some large companies will start the earnings seasons this week. And amongst the large sectors, consumer discretionary staples are expected to contribute more significantly to 2022 growth compared to 2021, because the government policies to stabilize the economy is requiring consumption to be at a healthy level. And these two sectors are obviously in the heart of that. And in the meantime, communication services is benefiting significantly from the pandemic-led stay-home restrictions. So we think that growth in this sector is also going to be quite important as well to the earnings outlook.
Okay, so let's end on a little bit of a cautionary note. So obviously, we're getting a lot of questions from our clients saying, okay, bond prices are going down, equity prices are going down. What are the best ways to hedge the downside risk in portfolios in this environment? A natural option is the Japanese yen. Often does very well in risk-off environments. Hasn't actually done so well this time. But do you think looking forward? Do you think it's a good portfolio hedge?
Well, on the yen, in terms of medium-term valuation models, it is looking extremely cheap. As a popular funding currency, it is also oversold. But on the other hand, if you listen to what Governor Kuroda said, he does not think that monetary policy would be turning hawkish, okay, which could pressurize the Japanese yen or keeping it relatively weak. If you look at the charts, you can see that the dollar yen is registered at double top around 116.35, and there is strong resistance up to 117. On the other hand, there's downside support from 112 to 113.50, but this support could be quickly tested in a risk-off scenario. Okay, so basically, against this backdrop, we think that long yen positions may offer an attractive hedge in the event of escalating risk in the markets.
Okay, that's all that we have time for today. Daniel, thank you so much for your insights. As always, it's been a pleasure to talk to you. Thank you, listener, for listening in today. It's really good that you've joined us as well. Please, obviously, feel free to rate and review and like us and wherever you get your podcasts. And in the meantime, please stay safe and keep well. Take care.
Thanks.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.